Okay, everyone, welcome to the results of round number 2 of your simulation, so your second week of the simulation. So this week you would have found there was actually a lot of growth up for grabs. Home loans grew at 12%, business loans grew at 8%, deposits grew at 5%, and credit cards actually went backwards, down 3%. And those losses, now remember, they're the credit losses, so the lending losses. So just remember that banks are always going to end up losing money. There are always going to be people who can't pay banks back. So that element of risk management is really, really important. Credit risk. Understanding the risk of individual customers and the risk of products and how those risks might change, and maybe pricing for those risks or thinking about mitigating those risks, that's really one of the most fundamental parts of banking. So for home loans, those losses are very, very low. 2 to 3 basis points or 0.02% to 0.03%. But for business loans, those losses are anywhere between 4 basis points to 120 basis points, or 0.04% to 1.2%, depending on your lending criteria. On credit cards, the losses are much higher, 2.75%. So remember we talked about this last week. Different products are going to have different levels of losses depending on their inherent risk characteristics. A product like credit cards is unsecured, meaning that if you don't pay your credit card back, the bank will basically not have any recourse to significant amounts of security. They might try to bankrupt you personally, but there's very little they can do, and therefore the losses are much higher. On the flip side, for home loans, if you don't pay your home loan back, the bank will probably sell your house, and therefore they will have some security. And so the losses are a lot lower on a home loan. That also means that when they're pricing for the risk or the price for a home loan is a lot lower than the interest rate on a credit card. When you miss your interest-free period on a credit card, the 55 days or whatever it is, sometimes you get charged in excess of 20%. But in the Australian market right now, the home loan price is around about 5 to 6%. So banks charge for the risk. So just bear that in mind. It's not about eliminating the risk altogether, but understanding the risk and charging for it. Okay, let's talk a little bit about margins this year. So what you had was a Reserve Bank cash rate increase this year, similar to what's going on in the real world. So there's a couple of things you need to think about when the Reserve Bank, or any central bank for that matter, raises their official cash rate. So remember that that's a short-term cash rate. That's basically the money, overnight money, the money which is being lent in the overnight market. So it's a very, very short-term rate. Now let's think about the yield curve for a moment. What's happening here is that the Reserve Bank or the central bank is sending a message. So the night of that, the cost of that overnight money starts to increase. Now, the bank bill swap rate, the 90-day bank bill swap rate, that's generally the rate which banks lend to one another in the money markets for about 90 days. That's the reference rate or the benchmark rate for a lot of very key things, including wholesale funding. That rate is a market rate. It tends to move very closely in line with the Reserve Bank cash rate, and what would happen is that would increase. So sometimes that actually increases ahead of a central bank cash rate change because it's a little bit more of a live rate, a market rate, and it will try to anticipate what the Reserve Bank is doing. So what would have happened here is that the bank bill swap rate has gone up. So imagine nothing else in the bank changes. What that means is the cost of existing wholesale funding, the reference rate for that has gone up. So the cost has gone up. So that becomes more expensive. So if banks do nothing, all of a sudden a portion of their cost of funding has become more expensive, which means they'll make less profit. So now they have a choice. What do? So they could charge their home loan customers and their business loans customers more to try to salvage that increased cost of doing business. And if they do that, they'll make more profit, but obviously those customers won't like it. And then they have the choice around the depositors. Now, a lot of those depositors, they link what they're earning in their deposits or their savings accounts to what is going on in the market, so to what the central bank is doing. And remember, a lot of these people are retirees and mums and dads who've trusted the bank with their savings. So they read in the newspaper, they see the official cash rate has gone up. They expect the amount of their savings to have also increased. So there's a bit of an expectation to increase it for savers as well. So if you increase it for savers, that means you're paying out more interest expense. So this is a challenge for banks because somebody is going to have their noses out of joint. So either customers will pay more, savers will earn less, or shareholders will get less. So it's not an easy decision to get right. So you can see here the black line on the top, the cash rate rose by 25 by 23 out of that 25. The red line down the bottom, the cost of wholesale funding, that actually went up a lot for all of you, went up by 48 basis points. So when you put those two things together, the green piece in the middle is your margin. Now remember, for a bank, this is what you do. This is the fundamental purpose of a bank: to borrow at a low rate, that red line, and to lend it out at a higher rate. That is banking 101. So most banks globally, around 70 to 80% of their income comes from this act. Now, just on this point about rising interest rates, so maybe let's think a little bit about some of the other things you've discussed in your classes. So we have talked about interest rate risk. Now, Silicon Valley Bank and Signature Bank in the US, there's been some big failures in the US, but let's maybe talk about Silicon Valley Bank because that's the big one. So what they did was they were a bank that lent to startups, venture capital type money. And they were very friendly with a lot of the startup community in San Francisco. And a lot of those startups would leave their excess money with Silicon Valley Bank. So they had a lot of deposits from startups. And the thing is that Silicon Valley Bank wasn't lending out much money. So they had all these deposits from these companies, but they weren't lending out much. So what they did was they actually chose to reinvest a lot of those deposits into RMBS, right? So residential mortgage-backed securities. They put it up into long-term bonds, things that they thought were safe. Now, those things are safe if you hold them to maturity. But what happened was, globally, we've seen in the last 18 to 24 months, central banks have been increasing interest rates. So imagine you have a bond and you've got this locked-in long-term rate on that bond, and all of a sudden interest rates start to go up. You all know the value of that bond starts to fall as rates rise. And that's exactly what happened here in Silicon Valley Bank. So those securities that they were holding started to fall in value. But that's not a problem if they didn't need to crystallize any losses. What actually happened was, in the tech sector in the US, it's been going under a lot of pressure. And a lot of these tech companies that left their deposits with Silicon Valley Bank needed their money back. And so they started to ask for their money back. And so as more and more of them took their money out, Silicon Valley Bank needed to sell some of the securities that it had invested in, and it crystallized losses. And when it crystallized those losses, they actually eroded a lot of their capital base, and they went out to shareholders and they said, we need some more money. And that alerted shareholders to the problem that was there, which was that they had locked up a lot of their money in these long-term instruments. And when that happened, then obviously in the age of social media, that spread like wildfire, shareholders not putting in any more money, depositors got very, very nervous. They pulled their money out of Silicon Valley Bank very, very quickly, and we had what's called a bank run. And that was basically what led to the failure of Silicon Valley Bank. That could probably not happen in Australia because APRA, who's the Australian regulator, has some very strict rules about interest rate risk. APRA is the only regulator in the world that makes Australian banks hold capital for interest rate risk in the banking book. Exactly what Silicon Valley Bank had. And that comes at a cost because Australian banks need to hold more capital than some of their global peers, but at times like this it makes them very, very safe. So it was a very good thing from the regulator's point of view here to build trust and stability in the system. Okay, let's have a look at the individual banks here. You can see NC Bank, your margins expanded by a whopping 19 basis points. Goldman's, you're up by 2, UNPB up by 33. Levitate down again 107. Tells down 81. Unibank down 60. And Group 7 up 14. So a bit of a mixed bag here. I think Group 7 has the highest absolute margins. Alright, let's take a look at business lending losses. Now, at the end of round number 1, these were anywhere between 100 to 150. Now they're bunched up between almost 150 to 250 million dollars. Now remember, as I said to you before, this is the lending losses. This is credit risk. And credit risk is part and parcel of being a bank. But have a think about, why are my losses increasing? Are they increasing because I've done something in my business? Are they increasing
in proportion with the growth of business loans. So that means if we looked at the losses as a percentage of my assets, that they'd proportionally remain the same. But my business loan business might be getting bigger. Or are they increasing because there's maybe an indication of worries, or customers are starting to default and the quality of my business is getting lower and lower? So just have a think about some of those questions. Remember, banking is not about eliminating credit risk altogether, but it's about understanding the risks and managing it appropriately. Okay, this year there was actually a deal room. So you had the ability to acquire the neobank. And the final due diligence came in and it confirmed neobank is going to grow at 25%, which was smack bang in the middle of the estimate that was provided to you. And their brand and their tech platform and their beautifully seamless onboarding experience would provide a competitive advantage. But there were some questions around integration, and from a cultural perspective, a lot of those key employees who worked for a new savvy tech startup, they didn't want to be associated with a boring big bank, and a lot of them left. And with them went some client relationships. So the starting point for your forecasts commenced from a 20% lower mark. Alright, so Tells, Levitate and UNBP not bidding. So that means we had 4 of the human banks all bidding as well, and the PC banks are bidding. That's to prevent you from picking up the neobank for $1. So PC Bank 1 bid 205. That would have given them a very, very healthy return of 26.7%. But they were outbid by NC Bank 23. You bid 293. So the returns are going down as those bids are going up. Group 7, a big jump up here. $440 million, the 17.4% return, but you still didn't do enough to get it. Goldman's, a big increase here, $625 million. That return is now 13.3%. So now we're starting to get to returns which are a little closer to our shareholder returns that were already there in round number 1. But Unibank, you take home the neobank, $673 million, a 12.5% return. It's probably just shareholder accretive for you. That's a pretty full bid there, but now you're married to that neobank for better or for worse. Alright, let's talk a little bit about bank bailouts. There's actually 3 banks here that have been bailed out. And those banks are Tells Bank, $48 billion, Unibank, $69 billion, Levitate, $138 billion. Now, when you go into your simulation again, and you go to the treasury screen, have a look. Is my asset bar matching the funding bar? And if it's not, raise wholesale funding until those bars are balanced and you have a little bit of extra cash or liquidity. Okay, if you need some assistance with this, if you look at the week 1 video, there's a whole little piece there on how to manage that treasury component. If you look at the intro video, there's a whole piece on that, and if you need help, you can always reach out to us through Look For, and we'd be more than happy to help you. Okay, wholesale funding issues. Now, these are the size of the bar tells you how much funding you've raised. So Levitate, you've raised a whopping $170 billion here. The percentages above cost tell you the cost of those funds. 8.93% for Levitate. That's a lot of money. Okay, it costs you very, very expensive. Tells 6.73%. All the way down. Goldman's 4.27%. UNPB not needing any at all this year. So entirely deposit funded. Alright, let's take a look at your profits. Now, the size of the bar tells you how much profit you generated. Now, you can see here, UNPB, you generated nearly $3.9 billion. The percentages in the middle tell you your return on equity. So that's the amount of profit you generated for the shareholders' funds that you needed. So UNPB, you generated 19.6, but look, Group 7 is actually generating a higher return on equity than you, even though they don't have the same amount of profit. So why is this important for banks? Now, you're going to talk a little bit more about capital probably in week 10 and 11. But every time banks generate profit, they have 2 choices of what they do with it. They can keep those profits. And when they keep those profits, they're basically retaining their earnings. And when they retain their earnings, that adds to their capital strength. And banks need to hold capital to protect against unexpected losses. Okay, they're protecting their depositors against unexpected losses. Different products that they write have different levels of risk, and they have to hold different amounts of risk-weighted assets against those. Basically capital. Or they can pay out the rest in dividends. So having strong, healthy profits is very important for banks in terms of generating that capital technical term used in the industry is organic capital generation. It's the way banks organically generate capital. Okay, so you can generate capital by asking shareholders to kick in money via a share issue, or you can generate capital organically by making more profits and not paying them out. Okay, let's get into our big two measures here. Customer satisfaction. In the real world, banks are obsessed with this because happy customers are less likely to leave, and the less pressure that puts on them to try to pick up new customers just to stay still or even to grow, and it's cheaper for them to keep a customer than it is to pick up a new one. So in round number 1, we have in first place by a long shot Levitate Bank doing really well on the customer side. Unibank in second. I think we have an equal third here between Group 7 and Tells. Alright, shareholder returns. Now look, all of your financial performance goes into this, but not only your historic financial performance, but the kind of bank you're building up. And even those customer measures do impact your business momentum. That's true in the real world and in the simulation. So there is a forward-looking element here too, as well as how much you've delivered to your shareholders to date. So at the end of round number 1, the top 3 and top 4 are actually very tightly packed here. UNPB in Group 7, I think you're in equal first. Then we've got NC Bank number 23, and then I think UNPB in there. Oh, sorry, my mistake. It's actually Tells Bank in there as well. And then we've got a little bit further behind Unibank, and then I think maybe Goldman's. And Levitate, some of those wholesale funding issues are really costing you, so please make sure you have a think about your treasury. So when we put it all together, here's your weighted ranking. Remember that if you are 1 on every measure, you'll be right at the top, which is where you want to be. And at the end of round number 2, we have a new first place. Well done to Group number 7. You've moved into first place. UNPB, you're in second. NZ Bank 23 is in third, and then Unibank, is in fourth place. And then a bit of a fight here between 5th, 6th, and 7th. So still 2 rounds to go, a long way to go. This year you've got an executive decision. So the reason we're doing this is because in the real world, you'll realize this when you go into your workforce, into banking. Hopefully all of you have wonderful careers in banking, but the decisions that banks have to face become less black and white and more grey as you get more and more senior. And in uni, we can often sit exams and do tests and there's a right and a wrong answer. But in the real world, this is not the case. You've got all these different stakeholders that are sometimes conflicting. So what we want you to do in this is we're going to present you with some real world operational failures. So these are things that major banks in the industry have had to deal with. And often this led to significant operational risk events. And the reason why it eventuated in that is not because the banks wanted to do harm, but it's because they didn't really adequately consider some of the ambiguity in the situation. And they made a decision and they just assumed that everything would go well, and it didn't. So we want you to put yourselves in those positions and have some of that discussion as a team. You've got 3 options. Choose one of your options, and we'll discuss this and unpick it for you as to how it played out in the real world. Alright, if you were last year's CEO, please appoint a new CEO. When you get into the simulation, click Appoint New CEO. Then you'll see a list of everyone in your team. Choose the person you want to promote. And that person, you get a little pop-up box saying, do you want to accept your promotion? Please say yes, or you won't get the pay rise that goes with being CEO. Alright, round number 3, economic environment. Where are we headed? Well, there's been a lot of talk about this, but we actually are in a global recession. So unemployment has skyrocketed, borrowers are defaulting, and customers are certainly falling behind. Debt investors are very nervous. In light of everything that's going on, the central bank is cutting rates to relieve pressure in the economy. So the bank bill swap rate has reduced by 25 basis points, as has the official cash rate. So when you get to your pricing screen, your business screen, have a think about whether or not you want to reduce your home loans, business loans and deposits by 25 basis points, or maybe more, or maybe less. Now, depending on your view of the world, you might think the recession was a necessary evil, but it's going to give us the opportunity to pick up a market share from struggling banks. Or you might think that this is just the beginning. We've entered into a position of lower for longer, batten down the hatches, buckle up the seatbelts because things are only going to get worse. Now, importantly, even though the central bank has reduced the official cash rate, so you'd expect wholesale funding might become cheaper, but that's only the reference rate. there's a spread that you pay on top of that reference rate. And in this current market, that spread has blown out. It's become very, very expensive. And the reason why is because investors are very nervous about what's going on. And for them to lend to anyone, including banks, they need to be compensated for what they perceive to be the risk in the market. Okay, so same decisions as last year. We'll send a little email around to look for so you know exactly what to do. Please don't hesitate to contact us. We'd love to talk to you if you do have any more questions on the simulation in round number 3. But all the best, and looking forward to speaking to you next week.